Welcome, welcome, everybody. I'm your host, Brett Rosenthal. This is the podcast, the ARMR Report. This is a show about stock market investing in the millennial age for you all who are the uninitiated. Thank you for joining us. If you're new, thank you for being here. If you've been with me for a while, you are helping me, hopefully as much as I'm helping you, because you're keeping me honest and you're making me execute. And that's the most important part of this process when it comes to investing correctly. ARMR Report stands for Algorithmic Risk Management Research. So everything I share with you, I come at from the standpoint of using algorithms to manage our risk when we're investing. That's the process in the millennial age. Post-2008 financial crisis released a new type of stock market. A market that moved away from some of the traditional fundamental thoughts about investing that you're comfortable with, that you're used to, perhaps that you were taught in finance classes in college. Things like central bank supports of markets have eroded the thought process of the smart investor and created a much larger class of what I'll call dumb investing, which is to say you put money in and you assume the market always goes up because that's what it's done since the financial crisis. So every time there's a sell-off, you think, I'll buy the dip, right? And we've seen a massive shift of capital from actively managed processes to passively managed processes. So if you're looking for a bubble in this market that's going to cause problems, it's that massive pool of passive capital. A bubble that was created in the millennial market is the belief that the markets always go up and then you can buy every dip. That's only true, guys. I'm here to share a piece of information with you that you need to understand. You got to own it. You got to write it down, put it above your desk if you're investing on a day-to-day basis or week-to-week basis. If you're a buy and hold guy and you're socking money away for your retirement, you got to write this down, put it above your desk. Okay, remember it. The markets only go higher on a consistent basis, and that ability to just buy every dip without thinking only works if the Fed's in your corner. If central banks are adding liquidity to the system, okay, you could be a dumb investor and pretend the markets always go up. But when central banks reduce liquidity, when the political environment changes, so that the Fed is raising rates and reducing liquidity, that's when you need active managers. And guess what? Most of them have been shot in the head. They're done. You know how many hedge funds have folded in the last 5 years? I mean, really smart guys out of the business. And they're out of the business because the bubble that was created that people should be concerned about, it's not a valuation bubble. It's not any of these other bubbles, people's credit bubbles and all these things. Believe me, what brings down the market the next time will not be credit bubbles, okay? History doesn't repeat like that. What did Mark Twain say? History doesn't repeat, it rhymes. It rhymes. It will be a bubble. The bubble will burst. What's the bubble? What keeps me up at night? What's most important to me is the bubble of passive assets. And here's the reason why. I've been doing this 30 years. I've been working with individual investors on a large scale for 30 years. When I lived in New York and worked in New York, my partners and I were managing the largest equity business in the country for Lehman Brothers before that name was a dirty name, and then for Prudential Securities in Wachovia, eventually Wells Fargo. the largest equity business in the country for those companies, for high net worth investors. So I've seen it all. I've spent a lot of time talking with people. I've witnessed a lot. And what I can tell you for certain is that 90% of buy and hold investors, which I would call passive capital, are passive to a point. They're buy and hold to a point. And when the market starts to unravel, there's a moment in time where that point of pain, that threshold is breached, and the panic ensues. And those buy and hope investors get blown out at the wrong time. That part of history will repeat itself, but it may rhyme. This time it's going to be worse because of the manipulation from central banks over the last decade has lulled people into a sense of security. And so when the selling gets started, guess what? There's not going to be any liquidity there. And the herd is all going to try to jump over the cliff at the same time. And the only way to combat that, algorithmic risk management. It's waking up. You've been a passive investor for the last 7, 8, 9 years, and you've made some good money. Congratulations. Well done. Don't give that all away now because you think the markets will always be like that. They're not like that. And Exhibit A is 2018. This is the year the Fed's reducing liquidity. What does your portfolio look like? How are you doing this year? That's a massive top that formed during 2018. And we don't know what's in store for 2019 if the Fed keeps raising rates and keeps liquidity tight. That's the problem. Algorithms should offer a certain amount of protection against that significant decline. Algorithms that we use are probability and statistical algorithms. So they're not guarantees. They're not AI. It's not neural networks. We're not looking into the future and predicting. We're reading and reacting to what we have right now. So when we tell you on this show, and you can follow us, hashtag ARMR Report on Twitter, which I try to update as much as I can. You can follow us on rosenthalcapital.com as I update our website with real-time risk-on, risk-off monitors. You can see our model portfolios and how we're invested right now, which through our affiliation with Interactive Brokers. And I do this show every day at 12 o'clock if I can. Today we had a technical difficulty, so it's 1:30. But what I'm going to do on this show every single day is share with you when risks and reward is out of balance to a significant enough degree to change our equity stance. And the algorithms help us determine that using probabilities and statistics. That's all we're doing here. It's not that hard. It's not rocket science. So when we come to you on the 24th of September and say, we are selling all of our small cap and all of our mid cap stocks, and I say to you, that is a leading indicator on where the rest of the market is going. So begin defending capital. You can then look at your own portfolio and determine, how do I want to take that information and put it to work for me? Okay. So today, I know that was a long preamble. Let me get to what the algorithms are saying. No change from yesterday's reversal. All 5 of our top algorithms that help us invest in the big index ETFs, the S&P, the Dow, the NASDAQ small cap, and momentum, all are negative. All are telling us to be in cash. They've been telling us that since the 4th of December. And I told you on the 4th of December that we had turned around and we started to go short for our aggressive accounts. I don't recommend shorting for the average investor. It's an emotional experience. It's not easy. I do it using the algorithms in our model portfolio at Interactive Brokers. So that is one way for you to get exposure to the short side, to link your account to our model portfolio, and you get those executions. So you basically, your portfolio mirrors what we're doing with our algorithmic aggressive account. But I don't recommend that for most people. I just tell you that so you know how can you use that information if you're not shorting. Know this: I very rarely short the market. And the reason's simple. I try to get you and myself, it's a live trading desk. I'm managing all my own personal capital. I'm managing capital for high net worth investors. I try to keep all that capital on the right side of probabilities and statistics. And the fact is, the market goes up, as we all know, 80% of the time. 80% of the time, the market goes higher. So shorting, every day I'm short, I'm on the wrong side of probabilities and statistics. So it's a very tricky endeavor. But I'm sharing the information with you, hoping to reach through this camera, put my arm around the individual who is a buy and hope investor and say, look, you've done well with that approach for the last 7-8 years. Don't give it all away. There are certain times in the market where we're willing to short because they're the most dangerous times to be long. So that's why I'm sharing the information with you. It's not to say you've got to go short, but it's to take those passive investors, if there's any watching this show, if there's any of you listening to the podcast, I hope there are some of you, because I know that a lot of the followers that I've got understand the process of algorithms and are learning from what we're doing here and tapping into our resource of information using our proprietary algorithms. And I love you guys for that. I love it, right? We're all in this together. But today, let's reach across the aisle and help a buy and hope investor. Send this podcast to a friend of yours. Send this live stream, send this YouTube video to your father-in-law or your dad or a friend who's made a lot of money in the last 7-8 years and is sleepwalking through this market now. Wake them up and explain to them this is the most dangerous time to own stocks. So you've got to protect capital however you wish to do that. And there's many ways to do it. I mean, you can have a long portfolio and buy equity index puts to protect it. Fine, do that. Don't disrupt your buy and hope portfolio. Maybe long term it will turn out to be exactly the way you expect. And I hope it does. I hope it does. But do something to protect your assets. Don't just sit there and believe in the government to save you as the market unravels and the stampede of passive investors all try to get out at once. So our algorithms are saying put on short positions. Okay. I promised in the title of this episode, I'd tell you how we're trading volatility. So you know we're in a stance of high alert, most defensive. That's where we're at right now, as defensive as we're ever going to get. I'm using my own personal account, equity index puts. I had S&P, Dow, NASDAQ, and small cap puts on. I covered my S&P puts, booked a profit, and I'm rotating that money into bigger positions in the Dow and the NASDAQ and the small cap. And the only reason is, I think it should be obvious, those other three indexes are more volatile than the S&P. So if the market's really going to get hammered, I'm going to make more money in those puts than I am in S&P puts. And I like to day trade. So how do I trade volatility? First of all, we have algorithms that are designed for intraday trading. And I use them. I'm not an intraday trader, but I use them to balance out risk in my portfolio depending on the day. Example, how do I trade volatility? I come into the day short. Forget about today. I come into the day short a couple days ago, and the market is plummeting at the open. So I'm making a lot of coin. I use the intraday trading algorithm to tell me when to get long the S&P to hedge off some of that risk. This is precisely what I did yesterday. Market was down big in the morning, got an opportunity to get long. Market ripped higher the rest of the day. I made money on my long intraday trade while I stayed in position on my shorts. It cushions the blow of a reversal day. It cushions the emotion. And it's really a nice way to trade. I mean, I don't mind taking small losses on those intraday trades because I'm making so much money short, right? So if I put a position on intraday and I get stopped out for a small loss, who cares? I'm making even more money as the market goes down. But when it reverses and rips higher, I want to have some exposure on to grab that that excess profitability and alpha in my portfolio. So I really only day trade when I'm trading against a bigger position. And when I feel that bigger position gets, statistically speaking, so far away from the mean that a snapback rally is normal. So if you're following me on Twitter, hashtag ARMR Report, you know that's what I was doing yesterday. I told you. And actually the day before, I think I told you. The volume weighted average price VWAP is an incredibly important tool on intraday trading and trading the volatility. It's like a magnet, particularly for the S&P 500, maybe more than any other index. The S&P likes to trade around the volume weighted average price. Now, we have a proprietary algorithm for VWAPs. I know I had a question on Twitter about that. What's the RCM VWAP? It's Rosenthal Capital Management VWAP. So it's our proprietary algorithm to determine what the volume weighted average price is. And the way it's different than a regular average VWAP is that we're literally taking volatility, top day and multi-day volatility, and incorporating that into our calculations for the VWAP. And so we find it's more accurate than the average VWAP. And so it's even more of a magnet, if you will, for prices. So when the markets are getting destroyed, great. I come in, I'm already long the puts, markets gap down, markets are getting hammered, markets down 500 points on the Dow, and we're so far away from the VWAP, the RCM VWAP. You know, we're more than 3 standard deviations away from the previous day's VWAP, not just top day, but the day before. So the 2 most important VWAPs for me are the top day, which is today's VWAP, and yesterday's VWAP, yesterday's closing VWAP. And so when we're way far away from yesterday's closing VWAP because we've gapped down in the morning and sold off hard, it's just statistically speaking to I don't even know exactly. I have to go do the calculations for you to give you an exact number, but it's something better than 90% of the time the S&P will go back and close that VWAP gap. So when we get X standard deviations away from it, I look to put a long trade on to capture that cushion there. It's called mean reversion trading. You can look it up. You can Google it. Mean reversion trading. When you get far enough away from the mean, as the Google explanation will tell you, an asset tends to trade back to the mean. The tricky part is figuring out what is the mean and what equals far enough away. So the RCM VWAP is the mean, and using our algorithmic statistics, we figure out when it's far enough away so that the reward, if we're right on the trade, is worth the risk. And that's when we put a trade on. So we did that yesterday, had the run up. Then we have a gap up this morning. So again, I'm trying to explain to you how I trade volatility. You know, my multi-day investment right now is to be short the indexes. So intraday trading, what do I do? And also, we know shorting is inherently dangerous and emotionally difficult. So if we can do things to reduce the risk and reduce the emotional experience, we'll have better results. So one thing we can do is when we're far enough away from the mean and we have a big enough gain on the short side and we get an algorithmic entry point because the reward of a snap back to the mean is worth the risk, we put that trade on all the time. And then hopefully at the end of the month of shorting, let's say, in our day trading basket, if you will, bucket, we have profits that have built up. Ideally, those profits are going to pay for my puts. And then I'm just playing with the house's money, and then I've gotten rid of emotion. It's not my principle. I'm building up a bucket of profits to pay for the puts, so now I can just hold the puts and not have the emotion of it. So that's how we trade volatility on this desk. So we come in and we look at a gap up. Let me explain how we trade gap ups. I told you the last couple of days we're looking for a reversion back to the mean, and when we get there, we're going to be adding shorts. So when we gap up this morning, I'm looking to put shorts out. I mean, we gapped right up to the VWAP of the prior day, which is 2 days ago at this point, because we closed above the VWAP yesterday. And then we gapped up this morning equal to or above the previous day's VWAP. So now we're back to that mean. And I look to see how the asset behaves. If it was a gap and go, I would have been looking long today. Excuse me, which means it gaps up and the first half hour, it continues to add to the gains. Gap and go. Gap and go days are days where I'm then looking to buy weakness the rest of the day. You'll have a run up, you'll pull back, you'll find support. If you get the right trigger, I get long there, try to make money on the long side. But what we had today was a gap and retreat. And in a bear market, a gap and retreat means you're going to go all the way down and close the gap. So I'm adding to shorts. That's what I'm doing today, adding to shorts. And I was adding to shorts at around anywhere between 10 and 10:30. Yeah, 10 and 10:30. Right in there is where I was adding to my shorts. Okay. Now the market, of course, is at its lows of the day. Well, now the market's, so the market gapped up huge and I'm adding to shorts. Guys, I hope you're picking up what I'm laying down. I handed the textbook of this to you the last couple of days on Twitter. So I hope it's helping you. And feel free to call me if you want to chat about it. I'll share with you how I do it. You can go to our website, rosenthalcapital.com. The phone number's right there. If I can, I'll pick up. Try me after business hours. It's easier when the market's closed, after market hours. But if I can do it in the middle of the day, I will. I mean, it's a live trading desk. I got trades on. Sometimes I got time. I've handed my playbook to you this week. The market gapped up. I said I would be adding to shorts if the market got back up to the VWAP. So I've done that. And now the market's coming down to yesterday's VWAP. It's closing the VWAP gap. So we're just trading between VWAPs. We're mean reversion trading. And so to me, it's going to be very interesting what happens when the market gets down. Let's look at the NASDAQ, for instance. Triple Q's 162.47 right now. 161.68 will be roughly almost exactly what the VWAP was yesterday's closing VWAP. So when we get down there, the question is, is there support? Is the volume weighted average price, when we get down there, going to offer support? Whoever was buying the market yesterday, is there more buying behind it? If there is, let's say it's a program trade. Let's say it's institutions, or maybe it's a central bank out there trying to support the market. Who knows? But they end up, institutions and big banks buy the VWAP. It's the sucker who buys everything else. Big institutions have orders that go out 30, 60, 90 days and they say, okay, I want to buy the VWAP whenever it gets there. That's how you get those nice uptrending stocks. You don't think an institution's hitting the offer, do you? No, that's just you. Stop it. Stop doing that. Don't hit the offer. Don't do that. So now we're going to come down and we're going to test where the real buyer is. Let me just take a peek here. Something. Okay, the Dow is at the VWAP from yesterday. So let's see how that behaves. The S&P, not quite yet. A little bit higher than the VWAP yesterday. The NASDAQ above the VWAP. And oh dear, oh dear, oh dear. Here's the thing that is most troubling about the market, but has also been the greatest indicator and has really helped us protect capital on our trading desk. The small cap index leads to the downside. And I keep referring back to the 24th of September. Forgive me, if I'm lacking in humility, I apologize. But when you get it right, sometimes you got to call it. If for no other reasons than to jog people's memories and to wake them up. And when we said you had to get out of the market on the 24th of September because the small caps are breaking down, ever since that point, the small caps have been leading the market lower. Every time the market has rallied, the small caps have suffered the first. They've failed quicker. They've made new lows on the year. And so what's happening today? Small caps are now trading below yesterday's VWAP. So they're again leading to the downside. And I submit to you that this market won't be done going down until small caps begin to stabilize. They're not even remotely stable. And they're the first to break through support levels on the downside. And so the rest of the market follows. And so what we need are one of two things. One, small caps stabilize and they stop going down. Or two, small caps hit new lows and the rest of the market doesn't, and you get a positive divergence. So it could be happening now, right? Let's see. Small caps are plummeting to new lows. They're below the VWAP. Let's see what the rest of the market does. Does it close above yesterday's VWAP? So maybe a divergence is beginning, and then we get a snapback rally in small caps, proving that the small caps have hit a bottom. Well, then maybe we've got a decent end of the year coming. But as of right now, sitting here right now, looking at what's going on, the trend to the downside is continuing. And so the way we're trading volatility is when we get a reversal day higher and a gap up in the morning, we're adding the shorts. And the way we're benefiting, if we can, intraday, is big sell-offs in the morning, we look to get long for a mean reversion. That's how we're doing it. I hope this has been helpful. I look forward to talking to you again tomorrow at 12 o'clock. Hopefully the Blog Talk Radio will be working correctly, and so will the rest of my equipment. If not, I'll just let you know on Twitter the time that I'm going to come on. I wish you all the best of luck. Thank you for joining me. You're really helping me out, keeping me honest, making sure I execute appropriately. And I hope I'm helping you out with an information source that you can't get anywhere else and that is valuable and derives from a process that really only institutions have access to now. So I'm trying to share with you institutional information. Wish you all the best of luck. Take care.